Welcome back to Journey to XRP. Before we talk about charts, opinions, or short-term price movement, there's something more important that needs to be said right at the start. The crypto market right now feels quiet, almost sleepy, and that's exactly why it deserves your full attention. Historically, markets don't make their biggest moves when everyone is excited. They make them when participation drops, volatility compresses, and people mentally check out. That's where we are right now. XRP is sitting around the same levels it's been hovering at for a while. Bitcoin is well below its recent highs. Ethereum is still struggling to reclaim key psychological zones. On the surface, nothing looks urgent. And because of that, a lot of people are tuning out, especially going into a holiday week where traders take time off, desks are lightly staffed, and volume dries up. That's not bullish or bearish by itself. It's context. Low participation creates low liquidity. Low liquidity doesn't mean nothing happens. It means moves become sharper when something does happen. Algorithms don't take holidays. News doesn't stop because it's Christmas week. Macro data still prints. Political statements still land. And when liquidity is thin, reactions can be exaggerated in both directions. So the first thing to understand is this. Quiet markets are not safe markets. They're fragile markets. This week alone, there are economic data points that matter. GDP revisions, jobless claims, and broader macro commentary can still ripple through risk assets, even if most people aren't watching closely. Add geopolitics, policy headlines, or unexpected comments from leadership, and you have the ingredients for sudden moves, not because fundamentals changed overnight, but because positioning was light. That's why this phase requires restraint, not excitement. Now let's bring this back to XRP specifically. One of the biggest mistakes people make during periods like this is assuming that lack of price movement equals lack of progress. That assumption has destroyed more good positions than bad analysis ever has. Markets don't move in straight lines and they don't reward constant activity. Sometimes the correct action is simply understanding where you are in the cycle. Right now, we're in a phase where narratives are diverging. Some analysts are talking about oversold conditions, historical setups, and eventual rotations into altcoins. Others are warning about choppy conditions, drawdown risk, and instability into early next year. Both sides are pulling data to support their case. And here's the uncomfortable truth. Both can be right depending on time frame. This is where most people lose the plot. They treat markets like they must choose one outcome. Either everything is bullish or everything is bearish. Real markets don't work like that. They operate across multiple horizons simultaneously. Short-term risk can coexist with long-term opportunity. Defensive positioning does not invalidate long-term conviction. You're seeing this play out in real time with how different analysts interpret the same environment. Some focus on liquidity cycles, technical compression, and eventual easing. Others focus on near-term macro headwinds, policy uncertainty, and positioning risk. That's not contradiction, that's nuance. And nuance is exactly what gets lost on social media. This is why comparing one analyst's bullish comment against another analyst's cautious stance is usually meaningless unless you understand who they're speaking to and over what horizon. Long-term allocators don't manage risk the same way traders do. Funds don't behave like individuals. They can reduce exposure short-term while remaining structurally bullish long-term. That distinction matters enormously right now. For XRP holders, this is especially important because XRP has always lived at the intersection of macro, regulation, and liquidity. It rarely moves when retail expects it to. It tends to move when conditions align quietly, often after extended periods of frustration. So instead of asking whether XRP is about to pump this week or dump next month, the better question is this: what phase are we actually in, and what does that phase demand from us as participants? Because holiday weeks, low volume, mixed narratives, and compressed volatility are not signals to panic or chase. They are signals to slow down, reduce emotional decision-making, and reassess positioning with clear eyes. To make sense of where we are right now, we need to stop thinking in terms of single predictions and start thinking in terms of scenarios. Markets don't move based on one opinion or one chart. They move based on how different forces interact: liquidity, macro policy, positioning, and psychology. And right now, those forces are not aligned in one clean direction. On the macro side, there are legitimate reasons for caution. Economic data remains mixed. Growth is slowing in some areas while inflation remains sticky in others. Central banks are walking a tightrope, trying to manage expectations without triggering instability in bond markets. Political risk is also creeping back into the picture, with fiscal debates, potential government shutdowns, and policy uncertainty resurfacing as we move into the new year. None of this is catastrophic, but it does create friction. That's why some analysts are openly saying the first part of next year could be choppy and unstable. Not because the long-term thesis for crypto is broken, but because transitions are rarely smooth. Liquidity doesn't flip from tight to loose overnight. Risk appetite doesn't suddenly surge just because people want it to. There is often a messy middle where markets move sideways, fake out both sides, and punish impatience. At the same time, there are also strong arguments on the other side. Liquidity conditions are not static. Expectations around future easing matter just as much as current policy. Historically, markets tend to move ahead of actual policy shifts, not after them. This is why some analysts remain constructive into the medium term, especially once uncertainty begins to resolve and capital can reposition with more confidence. This is where a lot of confusion comes from. People hear choppy and assume bearish. They hear bullish and assume immediate upside. In reality, choppy markets are often the bridge between contraction and expansion. They feel unproductive, but they're necessary. Now let's talk specifically about crypto's internal dynamics, because they add another layer to this picture. Bitcoin has already had a massive move off its cycle lows. Ethereum and most altcoins have lagged significantly. That divergence is not unusual. In previous cycles, Bitcoin tends to move first, establish dominance, and only later does capital rotate outward into other assets, if conditions allow it. The key phrase there is if conditions allow it. Rotation into altcoins is not automatic. It requires liquidity, confidence, and narrative alignment. Right now, those elements are only partially present. That's why altcoins feel heavy, even though many are deeply oversold on long-term metrics. Oversold does not mean undervalued in the short term. It simply means price has fallen faster than sentiment can recover. This is also why technical indicators can be misleading if used in isolation. RSI, MACD, and trend lines provide context, not certainty. They tell you when markets are stretched, not when they must reverse. Without a catalyst, markets can remain stretched far longer than most people expect. That's why professional investors don't rely on one signal. They layer macro, technicals, flows, and behavior, and when those signals conflict, they reduce risk rather than force conviction. This brings us to the discussion around different analyst views you're seeing right now. Some voices are focused on the potential for a renewed expansion once liquidity improves. Others are focused on near-term headwinds, tax dynamics, and post-cycle digestion. These aren't mutually exclusive positions. They're reflections of different mandates. A hedge fund managing risk quarter to quarter will behave very differently than a long-term allocator thinking in multi-year horizons. A trader will cut exposure where an investor may hold or even accumulate gradually. Neither approach is inherently right or wrong, or they're context dependent. This is the mistake most retail participants make. They consume opinions without asking, for whom is this advice intended and over what time frame? When you don't ask that question, you end up reacting emotionally to information that was never meant to guide your decisions in the first place. For XRP holders, this matters even more. XRP's behavior has always been asymmetric. It tends to underperform for long stretches, test conviction, and then move aggressively when alignment finally happens. That doesn't make it special or guaranteed. It just means timing matters more than most people are comfortable with. So where does that leave us right now? It leaves us in a market that is undecided in the short term, but still structurally intact in the long term. It leaves us in a phase where discipline matters more than excitement, and it leaves us with a choice: react to every opinion we see, or build a framework that allows us to sit through uncertainty without self-sabotage. Now let's bring the focus back to XRP, because this is where a lot of confusion creeps in, and people start mixing time frames in a way that leads to bad decisions. XRP right now is being judged almost entirely on short-term price response, while the developments around it are structural and slow-moving by nature. That mismatch is the source of most frustration. The introduction of XRP-related ETFs is a good example. Many people expected immediate upside, the same way they emotionally expected it with Bitcoin and Ethereum. That expectation was flawed from the start. ETFs are not momentum buttons. They are access mechanisms. They open doors to capital that previously could not participate. Retirement accounts, regulated funds, institutions bound by compliance mandates. That capital does not rush in on day one, and it certainly does not buy the way retail does. When ETFs launch into a market that is already trending down or sideways, price reaction is often muted or even negative in the short term. That does not mean the product failed. It means the market environment is absorbing supply while infrastructure is being built. We saw this with Ethereum. We saw it with precious metals in earlier decades. The pattern is boring, slow, and psychologically difficult, but it's consistent. What matters more than price is liquidity behavior. Liquidity does not just mean volume on an exchange. It means depth, accessibility, and the ability for large capital to move in and out without disrupting the market. ETFs contribute to that over time. They don't flip a switch overnight. This is where a lot of people misread XRP's current position. XRP is not struggling because it lacks interest. It's struggling because it sits at the intersection of regulation, settlement, and institutional usage. Assets in that category don't move first. They move once systems are ready to use them at scale. Another important point here is how capital actually flows. Many institutional allocations do not touch the public order book directly. They move through structured products, custodians, and over-the-counter channels. That means buying pressure does not immediately translate into visible price action. Retail sees price stagnation and assumes nothing is happening. In reality, positioning can be occurring quietly beneath the surface. This disconnect creates disbelief. People ask how XRP can be seeing growing institutional discussion, ETF interest, and infrastructure development while price does nothing. The answer is simple. Markets price urgency, not preparation. Preparation happens first. Urgency comes later. This is also where narratives around failure tend to emerge. When expectations are front-loaded and reality is back-loaded, disappointment fills the gap. That's not a reflection of fundamental, it's a reflection of impatience. Long-duration assets require long-duration thinking. XRP has always punished people who tried to force timelines onto it. That doesn't mean blind holding is a strategy. It means understanding what you own and why you own it. XRP's value proposition has never been about being the fastest mover in speculative cycles. It has been about utility, settlement efficiency, and liquidity bridging within regulated systems. Those things take time, coordination, and permission. This is why comparing XRP's performance to meme assets or pure speculation plays leads to the wrong conclusions. Those assets thrive on attention. XRP thrives on adoption. Attention comes and goes. Adoption compounds slowly, then suddenly. Right now, we are still in the slow part. This is also why you see smart participants thinking in ranges, scenarios, and probabilities instead of certainties. They are not trying to guess the exact bottom or top. They are managing exposure in a way that allows them to stay in the game without emotional exhaustion. XRP has always been a test of patience more than conviction. People don't usually exit because the thesis collapses. They exit because waiting becomes uncomfortable. That's the psychological cost of holding an asset whose payoff is tied to system-level change instead of narrative cycles. At this point, the most useful thing we can do is step back and talk about behavior, because strategy matters more than predictions in phases like this. Quiet markets expose habits. They expose whether someone has a framework or whether they're just reacting to whatever crosses their screen that day. Right now, a lot of people feel conflicted because they're hearing intelligent arguments on both sides. Some analysts are pointing to oversold conditions, long-term cycles, and eventual liquidity expansion. Others are pointing to near-term macro risks, choppy price action, and the possibility of deeper pullbacks. The mistake is thinking you must choose one side and reject the other. You don't. Markets don't operate on single narratives. They operate on layers. Short-term risk management and long-term conviction are not enemies. They are complementary tools. Institutions understand this very well. That's why you'll see funds reduce exposure tactically while remaining structurally bullish over multi-year horizons. That's not flip-flopping, that's discipline. For individual participants, the challenge is psychological. When price is boring, confidence erodes. When price moves against expectations, doubt creeps in. And when everyone around you is louder than the market itself, it becomes tempting to overreact just to feel in control. That's where most damage happens. This phase doesn't reward activity, it rewards clarity of intent. If you're here for short-term trading, then you need to accept volatility, stops, and the possibility of being wrong quickly. If you're here for long-term exposure to XRP's role in regulated settlement and liquidity, then you need to accept periods where nothing seems to happen at all. Mixing those two mindsets is what causes frustration. Another important point is information filtering. Not every opinion you hear is meant for you. Some commentary is designed for traders managing daily risk. Some is designed for allocators thinking in years. When you apply the wrong advice to the wrong time frame, you end up sabotaging your own position. This is especially true in crypto, where sound bites travel faster than context. A bearish short-term outlook can coexist with a bullish long-term thesis, but social media tends to flatten everything into absolutes. That's not how real decision-making works. XRP, more than most assets, forces you to confront this reality. Its story is tied to regulatory clarity, institutional infrastructure, and system-level change. Those things do not unfold on retail timelines. They unfold on regulatory and operational timelines, slowly, unevenly, and often invisibly until they're undeniable. So when the market feels dull, ask yourself a better question than, why isn't price moving? Ask, what am I expecting from this phase, and is that expectation realistic? If your answer is constant excitement, you're in the wrong market. If your answer is alignment over time, then quiet periods make sense. The goal right now isn't to predict the next move perfectly. It's to avoid making decisions you'll regret when conditions finally change. Overtrading, forcing entries, or abandoning a thesis out of boredom are all common mistakes, and they almost always happen in environments like this. Let's close this out by grounding everything we've discussed in reality. Crypto markets are not broken right now. They're transitioning. And transitions are uncomfortable because they strip away easy narratives. There's no clean trend to hide behind, no obvious signal that tells everyone what to do. That uncertainty is not a flaw, it's a feature. XRP sits right in the middle of that discomfort. Its short-term price action doesn't satisfy traders, and its long-term thesis requires patience most people underestimate. That combination creates doubt. But doubt does not mean the thesis is invalid. It means the market is still deciding how and when value is expressed. You don't need to predict the exact bottom. You don't need to time the perfect entry. And you certainly don't need to react to every opinion that crosses your feed. What you need is coherence between your strategy and your expectations. If your thesis is long-term, tied to regulation, liquidity, and institutional settlement, then periods like this are part of the cost. If your strategy is short-term, then you must respect risk and accept that choppy markets are designed to punish overconfidence. Both approaches can work. Confusing them is what causes losses. There is also no shame in caution. Reducing exposure, waiting for clarity, or doing nothing at all are valid decisions depending on your goals. Markets don't reward bravery, they reward discipline. And here's the part that matters most. Nobody knows the exact path forward. Not analysts, not funds, not influencers. Anyone pretending otherwise is selling certainty they don't have. The difference between professionals and amateurs is not prediction accuracy. It's how they manage uncertainty. XRP will either benefit from the alignment of macro, regulation, and adoption, or it won't. That outcome will be determined over time, not in a holiday trading week or a single quarter. Your job is not to guess the outcome perfectly. Your job is to make decisions that don't depend on being perfectly right. So slow down, filter noise, respect the phase you're in, and remember that markets often reward patience only after it feels pointless to keep it. And with that, a final reminder. This content is for educational purposes only and is not financial advice. Always do your own research and consult a licensed financial professional before making any investment decisions.